Imagine finding a hidden shortcut. Not one that bypasses hard work, definitely not, but one that makes your hard-earned dollars work smarter for you, especially, when your heart is set on giving back.
Mm-hmm.
We're talking about charitable giving today, but not just any kind of giving. We're
Mm-hmm.
taking a deep dive into the fascinating and I think often overlooked world of non-cash charitable contributions. Our mission, well, it's to uncover the potentially significant tax savings hidden within your generosity.
That's exactly right. For so many people, charitable giving, it kind of stops at writing a check, doesn't it?
It does.
But for those really looking to optimize their financial picture, this deep dive is all about equipping you with the knowledge to strategically identify what kind of non-cash property is actually best to donate and, crucially, how to properly value that donation.
And the goal here?
Well, the ultimate goal here is to minimize your current year tax liability. Really, turning your generosity into some genuinely surprising and potentially substantial tax benefits.
And trust us, you're probably in for some serious aha moments here. Over the next little while, we're going to unpack exactly what kind of property the IRS considers deductible for these non-cash gifts,
Mm-hmm.
how its fair market value is meticulously determined, and that's a big one.
Oh, absolutely.
The absolutely crucial reporting rules you need to follow to make sure your deduction actually counts, and, how various contribution limits can impact the total amount you can deduct in the end.
Quite a journey.
It really is. It's a deep dive into turning good intentions into, well, brilliantly smart financial moves. Let's make your assets work smarter for you.
Sounds good.
So let's unpack this financial strategy then. We're diving into the very foundation.
Right.
What exactly makes a non-cash donation deductible? And it all begins, surprisingly, not really with the property itself, but with the organization you're choosing to support. Not just any group qualifies, do they?
Precisely. No, this is absolutely the bedrock of the entire process. For your non-cash contribution, it doesn't matter how valuable it is. For it to be deductible, it must go to what the IRS calls a qualified organization.
Okay.
This isn't like a minor detail. It's the fundamental gatekeeper for your tax deduction. If the organization doesn't meet these specific IRS criteria, your generous donation, however impactful it might be in the world, simply won't yield a tax benefit for you.
Wait, so who exactly falls under this qualified organization umbrella? Because I can imagine there are just countless admirable groups doing really good work out there, but not all of them might meet the IRS's, well, very precise definition. What should our listeners be looking for?
That's a crucial question, yeah. The IRS has very specific criteria, and it's really important to verify an organization's status before you donate. Generally, qualified organizations include nonprofit groups with religious, charitable, educational, scientific, or literary purposes.
The usual suspects, kind of.
Right, the main categories.
Yeah.
It also extends to organizations dedicated to preventing cruelty to children or animals. Beyond those broader categories, we're looking at things like community chests, corporations, trusts, funds, or foundations that were created under U.S. law.
Okay.
And critically, are organized and operated only for those specific exempt purposes. Their charter, what they say they do, and their actual day-to-day operation are both key.
So it's not just about being a nonprofit in a general sense. It's really about their specific mission and how they're structured legally and operationally to achieve it. Are there any other, maybe less obvious, qualified groups that might surprise someone?
Yeah, there are a few. Certain amateur sports competition organizations also qualify, fostering athletic excellence without profit.
Interesting.
And maybe surprisingly to some, specific nonprofit cemetery companies are included. But, and this is a critical caveat, you cannot deduct contributions made for the specific care of a particular lot or mausoleum crypt.
Ah, okay, because that's a personal benefit.
Exactly. That's considered a personal benefit, not a public charitable one. Also, a significant one. Contributions directly to the U.S. government or any state, the District of Columbia, U.S. possessions, political subdivisions, or even Indian tribal governments are deductible.
Okay.
But only if the contribution is used solely for public purposes.
Like what?
Well, think about donating to help reduce public debt, maybe, or
Yeah.
for the maintenance and improvement of a public park or a historical site. That kind of thing would absolutely qualify.
That's a pretty comprehensive list for domestic organizations, but what if your charitable spirit, takes you beyond U.S. borders? How does international giving factor into this? Can I deduct a donation to, say, a conservation group in the Amazon or maybe a school in Europe?
Yeah, that's a common question. And generally, direct contributions to foreign organizations are not deductible under U.S. tax law. This is a really common misconception.
Oh, really?
Yeah. Yeah. However, there are very specific exceptions, and they primarily stem from income tax treaties the U.S. has. For example, under the United States-Mexico Income Tax Treaty, a contribution to a Mexican charitable organization can be deductible,
Okay.
but only if it would be treated as charitable to a U.S. public charity. And this is key. You have income from Mexican sources.
Ah,
In that specific case, the deduction limits would then be figured using your income from those Mexican sources. So it's tied to that income.
that's a very specific carve-out. And I assume there's maybe a similar situation for other countries as well.
Indeed, under the United States-Israel Income Tax Treaty, contributions to Israeli charitable organizations can also be deductible. Again, same conditions, basically.
Right.
They have to qualify as charitable contributions if they were a U.S. charity, and you must have income from Israeli sources.
Okay.
The deduction in this particular case is limited to 25% of your adjusted gross income, or AGI,
Yeah.
specifically from those Israeli sources. These are really quite narrow, treaty-specific exceptions. It highlights that direct international giving is usually not tax-deductible for U.S. taxpayers.
So if you don't have income from Mexico or Israel, it's generally a no-go for direct foreign charity donations tax-wise.
Yeah.
Is there any workaround? I mean, if you genuinely want to support a cause abroad and still hope to claim a deduction?
There is. There's a very common and, frankly, effective path people take. Contributions to U.S. qualified organizations that then send funds abroad can be deductible.
Okay, so through a U.S. intermediary.
Exactly. The critical elements here are that the U.S. organization must, first, approve the program as furthering its own exempt purposes. Second, it has to retain full control over the funds.
Control is key.
Absolutely. And third, it needs to ensure the foreign charity essentially acts as an administrative arm of the U.S. organization, rather than just receiving a direct, unrestricted grant.
Got it.
The structure ensures the funds are channeled through a U.S. entity that rigorously meets those qualified organization criteria, which then allows your donation to be deductible.
That makes perfect sense. It's like the U.S. organization acts as the vetted intermediary. Now, I've heard terms like for the use of a qualified organization versus to a qualified organization. Does that distinction actually matter? I mean, it sounds like an incredibly granular, almost legalistic detail.
It sounds granular, but it's anything but, actually. It's a crucial distinction, especially when we get to deduction limits later on. A contribution is considered for the use of a qualified organization when it's held in a legally enforceable trust or some similar legal arrangement for the organization,
Okay.
rather than being given to them outright for their direct control and use.
So to means they get it directly.
Exactly. To implies direct control and ownership by the organization. The IRS explicitly differentiates these because contributions for the use of an organization often have different AGI deduction limits, typically lower ones compared to direct contributions to the organization.
Okay. Lower limits.
Yes. So understanding that legal arrangement, whether it's in trust or given directly, is absolutely vital for correctly calculating your maximum deduction. And it's a detail, frankly, that many people miss.
Okay, so we've established who you can give to for that deduction. Now let's talk about what you can actually deduct. Because as much as we all want to be generous, we also need clarity on what the IRS recognizes for tax purposes, right?
Yeah.
What's the general rule for non-cash property?
Well, the general rule for non-cash property is quite compelling, actually. You can usually deduct the fair market value, or FMV, of the property you contribute to a qualified organization at the time of the contribution.
Okay, fair market value.
Yes, FMV. And this is where the non-cash aspect really shines, because you're not just deducting money from your bank account, you're deducting the value of an asset you already own.
Right, so let's dive into some specific examples then. What are the common types of non-cash contributions that are pretty clearly deductible?
Well, okay. Beyond direct money or property given to established religious organizations, churches, synagogues, temples, mosques, it includes property given to federal, state, and local governments, but for public purposes.
Like we mentioned, parks or debt reduction.
Exactly. Land for public parks, or maybe artworks for public museums. Nonprofit schools and hospitals are also standard qualified recipients. And of course, you have the universally recognized groups like the Salvation Army, the American Red Cross, Goodwill, the United Way, various scout organizations. Those all qualify.
What about those less obvious but maybe still significant contributions that people often overlook? I'm thinking about people who volunteer their time. A lot of people believe their volunteer hours are deductible, right?
That's a great point, and it is a really common misconception. While your time is obviously invaluable, you cannot deduct the value of your time or services.
Okay, no deduction for the time itself.
No. Meaning, You can't deduct the monetary value of the hours you spend volunteering, or, for example, the value of blood you donate to a blood bank. Your personal services are simply not tax deductible. However,
Ah, there's a however.
there is a however. You can deduct certain out-of-pocket expenses you incur while you're volunteering. These expenses have to meet a few criteria. They must be unreimbursed, they have to be directly connected to the services you're providing, and they must be expenses you had only because of the services you gave.
So not just everyday expenses.
Right. They cannot be personal, living, or family expenses that you would have had anyway.
So like if I need a special uniform to volunteer at a hospital maybe, or if I drive my car for a charity, those kinds of expenses are fair game.
Exactly. If you're, say, a volunteer nurse's aide for the Red Cross, and you're required to wear a specific uniform that isn't really suitable for everyday use, you can deduct the cost of buying it and cleaning it. Or, if you use your personal car to perform services for a charity, you can deduct your unreimbursed out-of-pocket expenses, like the actual cost of gas and oil that you used for those trips.
Or the mileage rate.
Exactly. Alternatively, you can use a standard mileage rate, which is currently 14 cents per mile for charitable driving. And critically, parking fees and tolls related to that charitable driving are deductible, regardless of whether you choose the standard mileage rate or you track your actual gas and oil costs.
That's really practical advice. And what about travel? Say if I'm volunteering somewhere far away, perhaps on like a week-long mission trip or something.
Travel expenses can indeed be deductible, but only if you're away from home overnight performing services for a qualified organization. Now, the absolutely critical condition here is that there must be no significant element of personal pleasure involved in the trip.
No funny business.
Right. For example, if you spend a full day attending a qualified organization's regional meeting as a volunteer representative, sure, you can claim your travel expenses for that. But if you then decide to, go to the theater in the evening, that specific cost isn't deductible. The primary purpose of the travel must unequivocally be charitable, and you have to be actively engaged in furthering the organization's mission while you're there.
So no mini vacations disguised as charity work. Got it. No voluntourism loopholes there. Okay, what about hosting a student? I've heard that can sometimes count as a charitable contribution. Is that true?
It can, yes.
Yeah.
And it's a very specific but potentially valuable deduction. You can deduct up to $50 a month for each full calendar month that a student lives with you. But it has to be under a written agreement with a qualified organization.
Yeah, written agreement.
Yes,
Yeah.
and there are strict criteria. The student cannot be your relative or a dependent you'd otherwise claim on your return.
Right.
And they must be a full-time K through 12 student attending school in the U.S.
Okay. And what expenses count?
Qualifying expenses include money you actually spend for their well-being, things like books, food, clothing, transportation for them. You cannot deduct the fair market value of lodging, like the rent value of the room,
Makes sense.
nor depreciation on your home or general household expenses like your property taxes or insurance. And importantly, if it's one of those mutual exchange programs where your child lives with a family abroad while their child lives with you, those costs aren't deductible for either family.
That's a very niche but interesting tax break. Okay, and for businesses, what about donating inventory, like surplus food? That seems like a big one.
It can be. For businesses, there are special rules for donating apparently wholesome food. Now, that's food intended for human consumption that meets quality and labeling standards, even if it's maybe not readily marketable due to appearance, maybe it's close-dated, or something like that.
Okay.
To qualify, the food must be used by the organization only for the care of the ill, the needy, or infants, and the organization can't transfer it in exchange for money or other property.
They can't sell it.
Right. And you also need a written statement from the organization confirming these conditions, just to ensure it truly goes to those in need and meets the criteria.
Okay, now for a flip side, and this is where people often get tripped up, what can't you deduct? Knowing these can save a lot of headaches, I imagine.
Oh, absolutely. This is indeed crucial for avoiding mistakes. First, and this is a big one, you cannot deduct contributions made directly to specific individuals, even if you try to funnel it through a qualified organization.
How does that work?
Well, for instance, you can deduct contributions to a qualified organization for general flood relief efforts. That's fine.
Yeah.
But you can't deduct it if your donation is specifically earmarked for, say, the Smith family affected by the flood.
Ah, okay.
It loses its charitable deduction status if it benefits a specific named individual.
So even if the individual is genuinely in dire need, if your donation is specifically targeted to them, it's out. What's the IRS's thinking there?
Exactly.
Yeah.
The IRS wants to ensure that the gift is truly for the broader public good, flowing through the qualified organization's general exempt purpose, not just a direct gift from you to a person using the charity as a pass-through.
Right.
It prevents the use of charitable deductions for what are essentially personal gifts. You also can't deduct contributions to non-qualified organizations. This includes things like civic leagues, social and sports clubs, labor unions, homeowners associations, groups run for personal profit, or political groups and candidates. Their primary purpose just isn't strictly charitable, as defined by the IRS.
Okay. What about things like buying tickets to charity events or maybe paying membership dues where you get something tangible in return? This is where that quid pro quo rule comes in, right?
Absolutely. This falls squarely under the quid pro quo rule, which is really a cornerstone of charitable deductions. If you receive a financial or economic benefit in return for your contribution, like concert tickets, a dinner, special access, merchandise, you can only deduct the amount that exceeds the fair market value of the benefit you received.
Just the extra bit.
Just the extra bit. For example, if you pay $65 for a ticket to a church dinner dance, and the ticket's fair market value, what it would cost normally, is $25, you can only deduct $40.
Okay.
Same applies if you pay $40 for a movie ticket benefiting a charity, but the regular price of that movie ticket is $8. Your deduction is only $32.
And it doesn't matter if I actually go to the dinner or use the ticket.
Makes no difference. It's the availability of the benefit that counts, whether you use it or not. However, and this is a great tip, if you decide not to go and you return the ticket to the qualified organization for them to resell, then you can deduct the entire amount you originally paid because you ultimately receive no benefit.
That's a clever way to maximize your deduction if plans change. Okay, and what about things like tuition or payments for raffles? Those often feel like charitable giving, but they aren't, are they?
You're spot on. They're not. You cannot deduct payments for raffles, bingo, or lottery tickets. The IRS views those as forms of gambling, not donations.
Right.
Likewise, dues paid to country clubs or fraternal orders are generally not deductible. And tuition, this is a big one, even if paid to a parochial school or a nonprofit daycare center, is never deductible as a charitable contribution.
Never. Even if they call it a donation?
Never. This includes any fixed amount you might be required to pay in addition to or instead of tuition, even if the school labels it a donation. These are considered payments for goods or services rendered specifically, education, not a gift.
And a potentially tricky one for strategic planning. What if I receive a state or local tax credit for my contribution? That sounds like getting a double benefit, which the IRS probably isn't too keen on.
That's a very important point, especially for minimizing your current year tax liability. And you're right, the IRS has something specific to say about it.
Right.
If you make a contribution and you receive or expect to receive a state or local tax credit in return, your federal charitable contribution deduction will generally be reduced by the amount of that state or local tax credit.
Okay. Reduced.
Yes. The IRS doesn't want you to essentially double dip on tax benefits from the same donation, get a federal deduction and a state credit for the full amount. There is a narrow exception, though.
Okay.
If the state or local tax credit you receive doesn't exceed 15% of your payment amount, or 15% of the fair market value of the property you transferred, then your federal deduction isn't reduced.
Only 15%.
Yes. So, for example, if you donate $1,000 to a qualified charity and get a $700 state tax credit back for that donation, your federal deduction is reduced to just $300, $1,007. And that's true even if you can't actually claim the state tax credit that year for some reason.
Wow.
This is a critical detail to understand for your overall tax strategy as it directly impacts your bottom line federal tax savings.
So the IRS really doesn't want you to get two bites at the apple for the same act of generosity. That makes sense, I guess. Are there any other common non-deductible items people should be wary of?
Yeah, just a few more to quickly watch out for. You can't deduct contributions that could be undone by a later act or event unless there's only a really negligible chance of that reversal happening.
Like a conditional gift.
Exactly. If you give money for a school gym, but the money is refundable, if they don't manage to collect enough total funds for the gym, you can't deduct it until that possibility of getting a refund becomes negligible.
Okay.
Also, payments made directly to clergy that they can just spend as they wish for personal expenses are not deductible. Payments made to a hospital specifically for a particular patient's care, also not deductible.
Right, direct benefit again.
Correct. And you cannot deduct expenses you pay for another person who provided services to a qualified organization. The classic example is parents paying their adult child's missionary expenses. The parents don't get the deduction.
Now that we know what qualifies and what doesn't, the next big hurdle, and maybe the biggest, is often determining the value of that non-cash property. This isn't always as simple as looking at a price tag, is it? Especially when we're talking about maximizing tax benefits.
Not at all. No. Pinpointing the correct value, that fair market value or FMV, is a really critical step, and it's where many complexities and, frankly, potential pitfalls arise. The core concept of FMV is the price a willing buyer would pay a willing seller,
Right.
with neither being compelled or forced to buy or sell, and both having reasonable knowledge of all the relevant facts about the property.
So it's what the market would bear.
Exactly. It's about what a genuine market would truly bear at the exact time of the contribution.
Right.
This isn't your original cost, necessarily, nor is it what you wish it was worth.
So it's not just what I think it's worth, or maybe what I paid for it 10 years ago. What factors actually influence this FMV in the eyes of the IRS?
Well, many factors come into play. Your original cost or the selling price of the item can be a good indication, but only if the purchase or sale was recent. It was at arm's length, meaning between unrelated parties and involved informed parties. Sales of comparable properties are also a very strong indicator. What did a similar item sell for recently in a similar market? Sometimes replacement cost is considered, but only if it's reasonably related to the current FMV. And of course, the opinions of professional appraisers are often essential, particularly for higher value or unique items.
And other things, like condition.
Oh, absolutely. Beyond that, the desirability of the item, its current use, its physical condition, mint versus damaged, its scarcity, and the general market demand for that type of item all play a significant role. Is it a hot collector's item or something mass-produced and easily available?
And when is this value determined? Is it the day I decide I want to donate it, or is it when the charity actually gets it in their hands?
It's generally the date the property is delivered to the charity, or when the legal title is transferred, provided you don't retain any rights that limit the charity's use or enjoyment of it.
Okay, date of delivery or title transfer.
Right. For instance, with publicly traded stock, if you physically mail a properly endorsed stock certificate, the date of mailing is often considered the date of contribution. But if you deliver it to your broker, or the issuing corporation for transfer into the charity's name, the date of contribution is usually when the stock is actually transferred on the corporation's books.
Timing matters.
Yes. And what's absolutely crucial is that you cannot consider unexpected events that happen after the donation date. Only facts known or reasonably expected at the time of the gift count for valuation.
Okay. Now, I've heard cautionary tales about inflated values, especially with items maybe bought from promoters who claim some sky-high retail value for something you actually bought for much, much less. Is that something the IRS watches out for? Because it sounds like a major red flag.
Absolutely. This is a significant issue, and yes, something the IRS scrutinizes very closely. You need to be exceedingly wary of promoter prices or retail values that seem, frankly, too good to be true.
Right.
The deductible amount will typically be the price at which similar quantities of that exact item are being sold to the general public at the time of contribution, not some artificially inflated retail value presented by a promoter just to entice a donation based on a big tax break.
Can you give an example?
Sure. Let's say you buy, 500 religious books for $1,000.
Yeah.
And the promoter you bought them from then claims they have a $30,000 retail value for tax deduction purposes if you donate them.
Okay.
Your deduction is typically limited to that $1,000 you actually paid, unless you can genuinely prove that similar quantities of those exact books were actually selling for $30,000 in the open market at the time you made the donation.
Which seems unlikely if you just bought them for $1,000.
Exactly. The IRS has seen these schemes before. They target them, and they're very quick to disallow those inflated deductions.
So, bottom line, if I bought something recently for $1,000 and I'm donating it pretty soon after, it's probably worth about $1,000 for deduction purposes, regardless of what some promoter claims its theoretical retail value is. It's about what it truly trades for in the real world.
That's a very good general rule of thumb, especially if the purchase was recent and at arm's length. The IRS is focused on the actual, verifiable market value at the time of donation, not theoretical or artificially inflated prices. And remember, the burden of proof is always on you, the taxpayer, to justify the claimed FMV.
Let's get into the specifics then of valuing different types of property, because it's clear a one-size-fits-all approach just won't work here, starting with perhaps the most common non-cash donation. Clothing and household items. You know, the bag of clothes dropped off at Goodwill or Salvation Army.
Yes. The quintessential non-cash donation for many households. The key nuance here, and it's a big one, is that used items almost always have a much lower fair market value than when they were new.
Much lower.
Much lower. Don't fall into the trap of thinking what you paid for it years ago is relevant at all. A good measure of value is what buyers actually pay for similar items in places like consignment shops, thrift stores, or even online marketplaces that deal in used goods.
So real-world used prices.
Exactly. So that $300 designer coat you bought 3 years ago, if similar used coats are selling for maybe $50 in a local thrift store today, your deduction is realistically limited to that $50. It's not about your nostalgia or your original cost, but what it's worth now on the secondary market.
That's a really common misconception, I think, and a significant one for many households cleaning out closets. What about bigger ticket items like cars, boats, or aircraft? These often have clear Blue Book values, which I imagine must make it simpler.
You'd think so, but there are specific rules. For what the IRS calls qualified vehicles, which includes most cars, motor vehicles, boats, and airplanes, the deduction generally has specific limitations, especially if the charity sells the vehicle without significant use or improvement. But even for determining the initial FMV, the acceptable value cannot exceed the private party sale price, as listed in a reputable used vehicle pricing guide,
Not the dealer price.
not the higher dealer retail value. So if a car is in the poor condition and a guide shows a dealer retail value of maybe $1,600, but the private party sale value is only $750, your FMV for deduction purposes starts at $750.
Okay.
And this value may be even lower due to specific issues like engine trouble, significant body damage, extremely high mileage, or excessive wear and tear. You have to adjust for condition. It's also important to note that these specific vehicle donation rules don't apply if you're, say, a car dealer donating a car from your inventory. That falls under different business inventory rules.
That's very precise. Okay, what about publicly traded assets like stocks and bonds? That seems like it would be the easiest to value, right? Given all the daily market data available.
For publicly traded securities, yes, it typically is easier because there are published daily quotations from major stock exchanges, over-the-counter markets, or mutual funds. The value is based directly on these readily available prices.
What if there's no sale on the exact day?
Good question. If there are no sales on the exact donation date, you typically use a weighted average of the high and low sales prices on the nearest dates before and after that donation date. If the stock is listed on multiple exchanges, you use prices from the principal exchange where it's primarily traded.
Okay, but what if it's not publicly traded or there are restrictions?
Right. That's where it gets complicated again. If prices aren't readily available, or if you're dealing with restricted securities like those with SEC resale limitations, or maybe very large blocks of stock that could materially affect the market price if sold all at once.
Like flooding the market.
Exactly. Then you're definitely going to need a professional appraiser. That kind of complexity requires expert analysis of market dynamics, supply and demand impacts, and specific regulatory restrictions. It's beyond simple market quotes.
Real estate is another big one. I imagine that's never a simple valuation, especially since every single parcel of land or building is unique.
Never simple, no. Real estate valuation is inherently complex precisely because of the uniqueness of each property. So it almost always requires a detailed appraisal by a qualified professional appraiser who specializes in real estate.
And what goes into that appraisal?
The appraisal needs a really thorough description. The property's address, its physical features, the current zoning, its potential uses, usually focusing on its highest and best use. Appraisers typically use a combination of methods. The most common is the comparable sales method, where they look at similar properties that have recently sold in the area and then make adjustments for differences in locations, size, condition, features, and so on.
Especially for land, right?
Yes, this is particularly crucial for unimproved land, where factors like exact location, size, zoning, accessibility, soil quality, water rights, and any existing easements are all weighed heavily. While the source material we reviewed doesn't go into exhaustive detail on all methods, appraisers also commonly consider the cost approach, what it would cost to build a similar property today, minus depreciation, and the income approach, especially for income-generating properties. Often, they combine these methods to arrive at a well-supported fair market value.
And art objects like paintings or sculptures, I know those can have wildly fluctuating values and often require very specialized knowledge. What's needed there?
Indeed. Art appraisals require incredibly detailed descriptions. We're talking dimensions, subject matter, the medium used, oil, watercolor, bronze, etc., the artist's name, the creation date, and a very careful assessment of the current condition, maybe even including a professional conservator's report if the condition significantly affects its value.
Wow. What else?
You also need to provide information on the cost, date, and manner of your acquisition. How did you get it?
Hmm.
The provenance or ownership history, who owned it before you, any exhibition history it might have, and crucial authenticity documentation, like citations in a catalog raisonné, if one exists for that artist.
Okay.
The valuation itself will then consider the item's unique artistic characteristics, comparable sales of similar works by the same artist or from the same school or period, the current economic state of the art market, is that segment hot or not,
Mm.
and of course the artist's standing and reputation. And you'll need a professional quality color image to go with the appraisal.
That's a lot of detail for art, but I guess it's understandable given the potential values involved. What about something really niche, like taxidermy property? That seems like an unusual category.
It is, and it has a very specific rule that kind of highlights the IRS's focus on genuine contribution value
Hmm.
versus, say, the value of your personal effort. If you prepared, stuffed, or mounted the taxidermy property yourself, or if you paid someone else specifically to do that preparation work, your deduction is limited to your basis in the property, basically what the unprepared animal cost you, or its fair market value after preparation, whichever is less.
Ah, so you can't deduct the value added by your own skill or the cost of the taxidermy service itself.
Exactly. This prevents you from deducting the value of your labor or the appreciation that results directly from your own efforts or skill in preparing the item. It has to be about the value of the underlying property contributed.
And back to businesses for a moment. What about donating inventory beyond food? Like, say, a bookstore donating unsold books, or maybe a clothing store donating last season's apparel. How is that valued?
For general business inventory, not the special food rules, the deduction is usually limited to your cost of goods sold for that inventory, essentially, your basis.
Hmm.
However, if the fair market value of the donated inventory is actually higher than your basis, there are special rules.
Okay.
You might be able to deduct your basis plus 50% of the appreciation, the difference between FMV and basis, but the total deduction is capped at twice your basis.
That sounds complicated.
It can be. These calculations often require a specific worksheet, which you can find in IRS Publication 526. It's definitely more involved than just deducting the FMV. And remember, for those apparently wholesome food donations we talked about, there's that special election where you can treat the basis as 25% of the FMV for part of the calculation, and the total deduction for food inventory is capped at 15% of your net income from the businesses making the contribution. So while potentially beneficial, these inventory deductions aren't simple plug-and-play numbers.
And finally, what about intellectual property, like maybe donating a patent or a copyright? How do you value something like that, which might generate income over time and whose future earnings could be pretty uncertain?
That's another complex area. For intellectual property like patents, future income streams are certainly relevant to the valuation, and you might even need to report certain future income related to the donation on a specific form, Form 8899. However, the valuation at the time of the gift should consider the entire earnings history of the IP, not just cherry-picked periods of rapid growth.
Be realistic.
Exactly. The focus should be on realistic, supportable trends leading up to the valuation date. Again, unexpected events or windfalls that happen after the donation date cannot be considered in the FMV calculation at the time of the gift. It's about a realistic assessment of its ongoing earning potential at that specific moment, not speculative future gains.
Okay, it sounds like for almost anything beyond, a small bag of old clothes or maybe some publicly traded stock, getting a qualified appraisal from a qualified appraiser becomes absolutely critical. When exactly is this professional appraisal required by the IRS? Because it's clear this isn't just about getting a casual estimate from a friend.
You've hit on one of the most critical aspects, especially for higher value non-cash donations. Generally, for any single item, or even a group of similar items like, say, a collection of rare books, a set of matched jewelry, or maybe a portfolio of non-publicly traded stocks for which you claim a deduction of over $5,000, you are required by the IRS to obtain a qualified appraisal.
Over $5,000 requires it.
Yes. This is not optional. It's a strict IRS requirement for most non-cash donations exceeding that threshold. There are a few exceptions, like publicly traded securities, but for most valuable property, $5,000 is the magic number triggering the appraisal need.
Okay, so if I'm donating a valuable painting, or maybe that rare stamp collection we talked about, and it's clearly over that $5,000 threshold, I absolutely need an appraisal. But what makes an appraisal qualified in the eyes of the IRS? Is there A specific format or set of standards it absolutely must adhere to?
Yes, a qualified appraisal is a very specific document with quite strict requirements.
Yeah.
It must be made, signed, and dated by a qualified appraiser. We'll get to who that is in a second.
Mm.
And it must be done in accordance with the Uniform Standards of Professional Appraisal Practice, or USP.
USP.
Yes, those are the generally accepted industry standard guidelines for ethical and competent appraisal practice. The appraisal's valuation effective date cannot be earlier than 60 days before the donation date, and it can be no later than the donation date itself.
Okay, tight window.
It is. And if the appraiser's report is dated on or after the donation date, the effective valuation date must be the actual donation date. Crucially, the appraisal report itself must be signed and dated by the appraiser no later than the due date, including any extensions, of the tax return where you're actually claiming the deduction.
So the appraiser needs to finish before you file.
Exactly. That's a tight deadline for the appraiser, but absolutely critical for the taxpayer claiming the deduction.
That's a very precise timeline. What specific information does this qualified appraisal need to contain? It sounds like it goes way beyond just putting a dollar amount on the item.
Oh, it absolutely does. The appraisal must be truly comprehensive. It needs a detailed description of the property and its physical condition at the time of donation. It needs the exact date of contribution. It needs to state any terms of a bargain sale. If applicable, that's where you sell it for less than FMV to the charity as part donation, part sale.
Oh.
It must include the name, address, and taxpayer identification number, TIN, of the appraiser, you as the taxpayer donor, and the donor organization receiving the gift. It also needs a clear statement of the appraiser's qualifications and professional background. Why are they qualified to value this?
Right.
A declaration that the appraisal was prepared specifically for income tax purposes. The appraised fair market value, of course. The specific valuation method used, like the sales comparison approach or cost approach we discussed. The specific basis for the valuation, what comparable sales or data did they rely on? And finally, the date the appraisal report was completed. It's not a casual estimate. It's a formal, robust, defensible document.
So the appraisal itself needs to be highly detailed and professional. Now let's turn to the appraiser themselves. What qualifies someone to be a qualified appraiser in the IRS's view? It really seems like they have strict rules to ensure impartiality and competence.
You're absolutely right. The IRS is very focused on both impartiality and expertise here. A qualified appraiser is defined as an individual with verifiable education and experience in valuing the specific type of property being appraised.
Specific type.
Yes, that is key. They must be knowledgeable and experienced in that particular field. You wouldn't ask a real estate appraiser to value fine art or vice versa. They generally need to meet one of two criteria.
Right.
Either have an appraisal designation from a recognized professional appraiser organization, or they must meet specific minimum education requirements, like relevant professional or college-level coursework, combined with at least 2 years of documented experience in valuing that precise type of property.
And this is where it gets really interesting and frankly maybe a bit chilling for some, who is explicitly not a qualified appraiser even if they seem knowledgeable or experienced. Because I imagine the IRS wants to prevent any conflicts of interest that could possibly lead to inflated values for tax deductions.
Absolutely. This is where the IRS draws a very clear, bright line to maintain impartiality and prevent abuse. You cannot use several categories of people as your qualified appraiser. These include 1. You, the donor, obviously. 2. The domestic organization you're donating the property to. 3. Any party involved in the original transaction where you, the donor, acquired the property, like the person you bought it from. 4. Anyone employed by or related to any of the above people or entities. 5. Anyone married to a person who is related to any of the above. This casts a very wide net of related parties.
Wow, okay. Keep it independent.
Definitely. Also, number 6, someone who receives what's called a prohibited appraisal fee. This means their fee is based on a percentage of the appraised value they come up with.
Ah, incentivizes a higher value.
Exactly. That's a crucial ethical standard for professional appraisers. They should be paid for their time and expertise, not a percentage of the value they determine. Number 7, someone who's been barred by the IRS from practicing before them within the 3-year period ending on the appraisal date.
Makes sense.
And here's the kicker, the one that truly highlights the IRS's vigilance and puts some onus on the donor. An individual is not a qualified appraiser if you, the donor, had knowledge of facts at the time that would cause a reasonable person to expect them to falsely overstate the value of the donated property.
So if I know the appraiser has a reputation for puffing up values or if we had some kind of wink-wink agreement beforehand.
Precisely. If you, the donor, had a prior agreement with the appraiser to inflate the value, or you knew they were unreliable or likely to overstate it, that appraiser is automatically disqualified for your donation, and relying on their appraisal could invalidate your deduction. This puts a huge burden of diligence on the donor to choose a reputable, ethical, and truly qualified appraiser.
Wow, that last point is really significant. The IRS is seriously cracking down on inflated valuations, and it puts the onus squarely on the donor to choose an ethical and competent appraiser. Are there penalties for appraisers themselves if they knowingly get it wrong and contribute to these misstatements?
Oh, definitely. Appraisers face potentially severe penalties for knowingly providing incorrect appraisals that lead to valuation misstatements on tax returns. If their appraisal results in what the IRS calls a substantial valuation misstatement, that's where the claimed value is 150% or more of the correct amount, leading to a significant underpayment of tax.
Okay.
They can face a penalty. It could be 20% or even 40% for gross misstatements, 200% or more of the correct value of the tax underpayment caused by their faulty appraisal, or 125% of the gross income they received for preparing that specific appraisal, whichever amount is smaller.
So, real financial consequences for them.
Absolutely. Beyond that, they can also be subject to penalties for aiding and abetting the understatement of tax liability under Section 6701, and their appraisal can be completely disregarded by the IRS, essentially rendering it useless for the taxpayer. This puts a significant ethical and financial onus on appraisers to be accurate, thorough, and completely unbiased in their work.
We've covered the basics of what qualifies and how to value it. Now let's maybe navigate some of the more nuanced and special cases that come up. And one of the most interesting and often quite complex categories is qualified conservation contributions, or QCCs. What exactly are these? They sound like they're about more than just donating a piece of land.
That's right. Qualified Conservation Contributions, or QCCs, are very specifically defined by the tax code. They are the donation of a qualified real property interest to a qualified organization, exclusively for certain defined conservation purposes. This is indeed about preserving land, or sometimes historic structures, and it's a highly specific area of tax law designed explicitly to encourage environmental and historical preservation through private philanthropy.
So it's not just donating any old piece of land you don't want. What actually counts as a qualified real property interest in this context?
Good question. It can be your entire interest in a piece of real estate, although typically excluding any mineral interests you might retain separately. It can also be what's called a remainder interest in property, meaning you donate the property now, but retain the right to use it for your lifetime or a term of years.
Okay.
Most commonly, though, a QCC involves donating a restriction on land use, such as a conservation easement, and this restriction must be granted in perpetuity,
Forever.
forever. This means the land's use is permanently restricted for specific conservation purposes. The done organization, the land trust or government agency receiving the easement, must also be qualified and, critically, must have the resources and commitment to monitor and enforce that conservation easement or other restrictions long into the future, forever.
And the donor has responsibilities too.
Yes, you, the donor, also need to provide thorough documentation like baseline reports with maps and photographs to clearly establish the property's condition at the time of the gift. This helps enforce the easement later.
And what are these certain conservation purposes that the IRS refers to? Does it have to be like pristine, untouched wilderness? Or can it include working lands like farms or forests?
It falls into four main categories, reflecting a pretty broad interpretation of conservation.
Preserving land areas for outdoor recreation by or for the education of the general public. Think public hiking trails or educational nature preserves.
Okay.
Number two, protecting a relatively natural habitat for fish, wildlife, or plants, or a similar ecosystem. This really covers biodiversity and ecological health.
Preserving open space, including farmland and forest land, if it yields a significant public benefit. Now, this benefit must be either for the scenic enjoyment of the general public or pursuant to a clearly defined federal, state, or local governmental conservation policy. This is where working farms and forests can sometimes fit in.
Ah, okay. Significant public benefit is key there.
Exactly. And number four, preserving a historically important land area or a certified historic structure. This covers our cultural and architectural heritage.
That makes sense. It's really about protecting environmental or historical assets for the public good, often permanently. But how on earth do you value something as abstract as a conservation easement? I mean, it's a restriction on use, not an outright transfer of the property itself. That seems hard to value.
It is. That's where it gets particularly tricky and almost always requires a specialized appraisal from someone experienced in conservation easements. The best evidence for the fair market value of an easement would be the sales price of comparable easements, if such rare transactions actually exist in the market.
Which probably isn't common.
Right, it's not very common. So, if there are no directly comparable easement sales, the before and after method is generally used. This involves getting an appraisal of the fair market value of the entire property before the easement is granted, and then getting another appraisal of the fair market value of the property after the easement is put in place, reflecting its diminished development potential.
And the difference is the donation value.
Exactly. The difference between the before value and the after value is consider the value of your charitable contribution, essentially, the value of the development rights you've permanently given up for conservation.
So just to clarify with an example, if I have, say, 10 acres worth $20,000 total, and I put a permanent easement on 8 of those acres, restricting them solely to farm use, which makes them less valuable for, say, building houses, the difference in value is my deduction. Can you walk us through how that might look?
Certainly. Let's use your example. Say your 10 acres are valued at $2,000 per acre, totaling $20,000 before any easement. Now, you grant an easement that restricts 8 of those acres permanently to farm use, preventing any future residential or commercial development on those 8 acres. An appraiser determines that comparable restricted farmland in that area sells for only $1,500 per acre.
Okay.
So those 8 restricted acres are now valued at $12,000, 8 by $1,500 under the easement. The remaining 2 unrestricted acres are still worth $2,000 each, or $4,000 total. So the after value of the entire 10-acre property is effectively $12,000 plus $4,000, totaling $16,000.
You got it.
Your easement value, and thus your potential charitable deduction, would be the difference. $20,000 before minus $16,000 after, which equals $4,000. It's the calculated value of the development rights you've permanently given up for conservation.
That clarifies it nicely. But I also heard you mention earlier that sometimes there's no deduction for a conservation easement, which sounds really counterintuitive if you're giving up development rights. How can that happen?
That's a crucial caveat and a point of frequent, intense IRS scrutiny, frankly. No deduction is allowable if the easement has no material effect on the property's fair market value, or, critically, if it actually enhances rather than reduces its FMV.
Enhances? How?
Well, for instance, if the property's use is already heavily restricted by existing zoning laws or other local regulations, and your conservation easement doesn't impose further meaningful restrictions beyond what's already legally required,
Ah, I see.
then you might not get a deduction. The easement must genuinely restrict the highest and best use of the property beyond existing limitations to be deductible. It's not enough to simply put into easement form restrictions that already exist by law.
Okay. What about those certified historic structures you mentioned? Are there even more specific rules for putting easements on those kinds of buildings? That sounds even more complex.
There are indeed additional specific rules for donating easements on certified historic structures. First, you need to understand the 2 types that qualify. It can be a National Register building, which is individually listed in the National Register of Historic Places,
Okay.
or it can be a historic district building. This is a building located within a registered historic district, and it has been separately certified by the Secretary of the Interior as being of historic significance to that district. Just being listed as contributing to a historic district generally isn't enough. It usually needs that separate certification to qualify for these special easement deduction rules.
And for these specific structures, what kind of documentation is needed beyond a regular qualified appraisal? It sounds like the IRS wants an absolutely ironclad case for these historical preservation deductions.
They do. To claim a deduction for an easement on a National Register building or for an interior easement on a historic district building, you'll generally need to file Form 8283, attach a signed qualified appraisal by a qualified appraiser, and include the National Park Service project number, NPS check, if one applies to the property.
Okay. And for exteriors?
However, for a restriction purely on the exterior of a historic district building, the requirements are even more stringent, really designed to ensure true long-term preservation.
What are those additional, more stringent requirements then? This really does sound like a potential minefield for the unprepared taxpayer.
It can be, yeah. The restriction must preserve the entire exterior. That means the front, sides, rear, and even the height of the building. And it must explicitly prohibit any changes inconsistent with its historical character.
Okay, very specific.
Very. Also, you as the donor and the qualified organization receiving the contribution must enter into a detailed written agreement. This agreement has to certify under penalty of perjury that the organization is genuinely qualified for historic preservation purposes, that it possesses the necessary resources to manage and enforce the restriction indefinitely, and that it is unequivocally committed to doing so.
Wow.
And there's more. You also must include high-quality photographs showing the entire exterior of the building at the time of donation, a detailed description of all relevant development restrictions, like local zoning laws or preservation ordinances, and the MPS tag, if applicable. It's a very high bar, designed to ensure that the contribution truly benefits the public by preserving genuine historic integrity for the long haul.
That sounds incredibly complex, especially if these structures are owned not by individuals, but by partnerships or S corporations. I've heard rumblings that there are specific anti-abuse rules targeting those pass-through entities in the context of QCCs. What's the deal there? That sounds serious.
You're touching on a critically important and very complex disallowance rule, yes. It's notably Section 170H of the Tax Code, and it specifically targets partnerships and S corporations making these contributions. This rule is a really stark warning from the IRS. It signals they are extremely serious about preventing certain perceived tax shelter schemes involving syndicated conservation easements.
Okay, so what does the rule actually say?
The rule essentially states that if a partnership or S corporation's claimed qualified conservation contribution exceeds 2.5 times the sum of each ultimate member's relevant basis in the property being contributed.
2.5 times basis.
Right. If the claim deduction is more than 2.5 times the partners or shareholders' combined basis in that property, the entire contribution deduction is completely disallowed, not reduced disallowed.
For everyone.
For everyone involved, the contributing partnership or S-corp, any upper-tier entities it flows through, and all the ultimate individual members or owners. This means absolutely no one gets a deduction, potentially wiping out a substantial intended tax benefit due to this one specific calculation or potential non-compliance. It's a massive penalty.
Wow, that's a huge, almost devastating disallowance rule. Is there any way around that or any exception at all?
There is a very narrow exception carved out for certain family pass-through entities if the property has been held for at least 1 year before the contribution. But this rule fundamentally highlights the critical need for incredibly careful planning, meticulous and accurate basis tracking for all partners or shareholders, and almost without exception, expert professional advice when dealing with QCCs originating from pass-through entities. It's a powerful deterrent against transactions the IRS views as abusive, and a misstep can cost a substantial amount of deductions for everyone involved down the chain.
Okay, so beyond the complexities of conservation easements, are there other specific property rules we should be aware of? You mentioned inventory from businesses earlier. Maybe we can revisit that briefly.
Yes, absolutely. For general inventory donated by businesses, again, outside the special food rules, the deduction is generally limited to your cost of goods sold for that inventory, which is essentially your basis. However, if the fair market value happens to exceed your basis, it can potentially be your basis plus 50% of the appreciation, but that total deduction is capped at twice your basis.
Still sounds complicated.
It requires calculation, often using a specific worksheet like those in IRS Publication 526. And remember, for that apparently wholesome food, there's this special rule allowing an election to treat the basis as 25% of the FMV for part of the worksheet calculation, and the total deduction for food inventory specifically is capped at 15% of your net income from the businesses making the food contribution. This is clearly designed to encourage donations of food to the needy by making the deduction potentially more valuable than just basis.
Okay. What about donating only a partial interest in something? Like maybe I co-own a valuable asset with someone else, or I just want to donate a fraction of something I own entirely. Can I just donate, say, 20% of a painting and get a deduction for that 20%?
That's generally disallowed unless it qualifies as an undivided part of your entire interest in the property.
Undivided part, what does that mean?
It means it has to be a fractional share of each and every substantial interest or right you own in that property, and it must extend over the entire term of your interest. So, using your painting example, yes, you could potentially donate an undivided 20% interest in that painting. That would mean the charity now co-owns 20% of the painting alongside you, and typically has the right to possess and use the painting for 20% of the year, or 20% of the time.
Okay, so shared ownership and rights.
It's exactly. However, You generally cannot deduct a contribution of what's called a future interest, intangible personal property. That means you can't donate something now, but keep the right to use it for a while. The deduction is generally postponed until all intervening interests or rights to actual possession or enjoyment held by you or related parties have expired or been transferred away. This prevents getting a deduction for property where you haven't fully given up control or future enjoyment yet.
And what about life insurance policies or maybe annuity contracts? Those seem like they'd have a straightforward value, maybe just their cash surrender value.
It depends. For life insurance or annuity contracts, the value for deduction purposes is typically the amount the insurance company would charge for a comparable new contract issued on the date of the gift. This is generally the replacement cost of the policy.
Oh, okay, replacement cost.
However, and here's a critical nuance again, if the done organization is reasonably expected to just cash in the policy immediately rather than hold it as a long-term investment, which is often the case, then the fair market value for deduction purposes is simply its cash surrender value at that time. This is usually much lower than the replacement cost. The IRS looks at the real economic benefit the charity actually receives, not just a theoretical replacement value if they're just going to cash it out.
Now, let's talk about a very common scenario that can definitely trip people up. Contributions from which you, the donor, also get some kind of benefit. We touched on this briefly with the charity dinner dance example, but what's the core principle here, that quid pro quo rule?
Yes, the quid pro quo rule.
Yeah.
The core principle is actually quite straightforward. If you receive, or even just expect to receive, a financial or economic benefit as a direct result of making a contribution, you cannot deduct the part of the contribution that represents the value of that benefit you received. Your deduction is only for the excess amount you gave beyond the value of what you got back.
Only the true gift part.
Exactly. This is the IRS's way of ensuring you're not deducting something that primarily benefits you personally, like just buying something from the charity.
So if I buy, say, a concert ticket from a charity for $100, but the fair market value of going to that concert would normally be $50, I can only deduct $50, right? That's the truly charitable portion of my payment.
Precisely. That $50 difference is the portion of your payment that truly represents a charitable gift, not a purchase.
Right.
And it's crucial to understand, as we noted before, that whether you actually use the ticket or attend the event or use the other privileges has no bearing on the amount you can deduct. It's the value of the benefit available to you or received by you that matters for the calculation.
But if I give the ticket back?
Right. But as we discussed earlier, if you decide not to use it and you return the ticket to the qualified organization for them to resell, then you generally can deduct the entire amount you originally paid for the ticket, as you ultimately receive no benefit from it. That's a good tip for maximizing your deduction if your plans happen to change.
That's a really clever way to maximize your deduction if plans change. Okay, what about things like membership fees or dues? Say, to a museum or maybe a public radio station. Often I get a newsletter, maybe early access to something. Is that considered a benefit that reduces my deduction?
Similar rules apply, yes.
Yeah.
You can generally deduct membership fees or dues you pay to a qualified organization, but only the amount that is more than the value of the benefits you actually receive in return.
Okay.
So if your $100 museum membership comes with, say, $20 worth of free gift shop items and special members-only exhibition access that has a measurable value, you can likely only deduct $80. However, there are exceptions for certain benefits the IRS considers disregarded or insubstantial.
Disregarded benefits? Like
All right.
what else?
These include things like token items of nominal value, maybe a small tote bag, a car decal, a basic newsletter or calendar that aren't high value, or certain intangible religious benefits that aren't usually sold commercially, like admission to routine religious ceremonies. In those specific cases, the full membership fee might still be deductible. But if you get significant tangible benefits like free admission to many exclusive events, preferential seating, or substantial discounts on programs or merchandise, you absolutely have to subtract the fair market value of those benefits from your contribution amount to figure your deduction.
All these rules for what to donate and how to value it are incredibly important, but like you said, none of it matters if you don't report it correctly and keep the right records. So let's talk about reporting and substantiation, making absolutely sure your deduction actually counts with the IRS. What kind of basic records do you need to keep for just general cash contributions?
Good question, because without proper records, your deduction might easily be challenged or disallowed upon audit. For cash contributions, which includes checks and credit card payments, You really should keep canceled checks, bank, or credit union statements that clearly show the name of the organization, the date the contribution cleared, and the amount.
Or a receipt.
Exactly.
Hmm.
Alternatively, a contemporaneous receipt or a formal letter from the organization showing its name, the date, and the amount will suffice. The paper trail is absolutely paramount here. The IRS generally won't just take your word for it.
And what if you're donating through payroll deductions, which many people do for things like the United Way or other workplace charities? What's needed then?
For payroll deductions, you need a couple of things. First, you need to keep a pay stub, your Form W-2, or some other employer document that clearly shows the date and the amount withheld for the charity. Second, you also need a pledge card or some other document prepared by or for the qualified organization. This document needs to show the organization's name and explicitly state that the organization doesn't provide goods or services in return for any contribution made by payroll deduction. So 2 pieces for payroll. Right. Both pieces of documentation are required to substantiate that deduction.
Okay, so that covers cash and payroll. But what about non-cash contributions, especially when they start getting a bit larger in value? I've heard about something called a contemporaneous written acknowledgement, or CWA. When is that specifically required, and what exactly is it?
Yes, the CWA. The contemporaneous written acknowledgement is absolutely critical for any single contribution, whether it's cash or non-cash, of $250 or more.
$250 or more, single contribution.
Correct. And it's really important to remember not to just combine separate, distinct contributions to meet this $250 threshold. For example, weekly church payments of, say, $50 are treated as separate contributions, even if they add up to well over $250 over the course of the year. Each one under $250 doesn't need a CWA on its own.
If I give $300 in one go,
Then you need a CWA for that specific $300 contribution. If you make multiple contributions of $250 or more during the year, you either need a separate CWA for each one, or the charity can provide one single comprehensive acknowledgement that lists each contribution individually, its date, and the total amount. This CWA is your primary proof for the IRS for those larger single donations.
And what exactly does this CWA need to include? It sounds like it has to be more than just a simple thank you note from the charity.
It definitely is. It's a formal requirement with specific content. The CWA must include
The name of the qualified organization.
the amount of any monetary contribution included.
A description, but critically, not the value of any non-cash property contributed. The charity cannot legally tell you the value for your tax deduction. Determining value is your responsibility as the donor.
Okay, description, not value.
Right. Number 4, a clear statement of whether the organization provided any goods or services in return for the contribution.
If goods or services were provided in return, the quid pro quo situation, the CWA must include a description and a good faith estimate of their value. And number 6, if the only benefit received was what's called an intangible religious benefit, like admission to a religious ceremony not generally sold commercially, it just needs a statement saying so, with no value estimate needed for that.
And the contemporaneous part of CWA, what does that mean in terms of timing? Because I assume getting it after you file your taxes would be too late, right?
Exactly. Contemporaneous means you must receive this written acknowledgement from the organization on or before the earlier of 2 specific dates. Either the date you actually file your tax return for the year the contribution was made, or the official due date, including any extensions, for filing that return.
So get it before you file.
Yes. Most reputable organizations typically send these CWAs out by January 31st of the year following the donation, which usually meets this requirement for most filers. But if you're filing early, or maybe if an organization's a bit slow, it's ultimately your responsibility as the taxpayer to make sure you obtain that CWA by your filing deadline. You can't claim the deduction without it.
So if I'm cutting it close on filing my taxes, I absolutely need to make sure I have that CWA in hand before I hit submit on my return, or I risk losing the deduction for that contribution. That's a really critical detail. Okay, now moving to even larger non-cash donations, what happens when the claimed deduction for an item or maybe a group of similar items like a collection is more than $5,000?
That's when you generally must complete and attach Form 8283, specifically Section B, to your tax return. This form, non-cash charitable contributions, is the big one for higher value non-cash property.
Section B for over $5,000.
Correct. And failure to attach this required form generally means your deduction for that property will be disallowed, unless you can later prove to the IRS that the failure was due to reasonable cause and not willful neglect, Or perhaps it qualifies as a good faith omission under specific circumstances. But generally, no Form 8283B means no deduction over $5,000. It's the IRS's primary tool for verifying and tracking significant non-cash donations.
What's involved in completing Form 8283 Section B? Does the charity have to do anything with it once I've filled out my parts? Is it just my form?
No, it's actually a joint effort that requires cooperation from the done organization. You, the donor, must complete at least column A for the detailed description of the property and column B for the quantity before you even submit the form to the done organization for that part.
Okay, donor fills out part first.
Yes. Then, the done organization must complete and sign Part V of Section B. In doing so, they acknowledge receipt of the property described and certify certain aspects of the donation from their end. For qualified conservation contributions, you also need to describe the easement terms in detail in Section B, including acreage, or attach a copy of the actual easement deed. And importantly, if you donate similar items to multiple different donees and the total is over $5,000, a separate Form 8283 is generally needed for each done.
And what happens if the charity then turns around and sells the donated property relatively soon after they receive it? Does the IRS track that somehow, and could it affect my original deduction?
They absolutely do track that under certain circumstances. It's tied to Form 8282 Dunning Information Return. The done organization generally must file Form 8282 with the IRS if they sell, exchange, consume, or otherwise dispose of the donated property within 3 years of receiving it from you.
3 years, okay.
Yes. There's an exception if the appraised value of the specific item was $500 or less. If they file Form 8282, the organization is also required to send you, the original donor, a copy. This helps the IRS track whether the property was put to a related use by the charity, which ties into those potential recapture rules we discussed earlier for tangible personal property. It helps ensure the charitable intent and use were genuinely fulfilled as represented.
And speaking of getting things wrong, what are the penalties if I, the taxpayer, overstate the value of my donated property on my return? The IRS sounds like they're pretty serious about this, especially given the penalties you mentioned for appraisers.
Yeah, very serious, yes. And the penalties for taxpayers who overvalue donations can be significant. This is a huge incentive to get the valuation right and have proper support. There are two main tiers. A 20% accuracy-related penalty applies if the value or basis you claimed on your return is 150% or more of the correct allowable amount, and this overstatement results in you underpaying your tax by more than $5,000, $10,000 for most corporations. This is called a substantial valuation misstatement.
20% penalty. Ouch.
It is. And the penalty jumps to a much steeper 40% if the value or basis you claimed is 200% or more of the correct amount, and it causes that same significant underpayment of tax. This is called a gross valuation misstatement.
40%.
40%. These penalties are designed to aggressively deter taxpayers from inflating donation values and to ensure people are diligent and honest in their claims, especially for non-cash items where valuation can be subjective.
That's a really strong incentive to get the valuation right or even be a bit conservative. Okay, what about that recapture for unrelated use you mentioned earlier? Specifically for tangible personal property, like art or collectibles, it sounds like the IRS can actually claw back a deduction if the charity doesn't use the item as expected.
That's an important consideration, yes. And it's designed to ensure that the spirit of the deduction for that type of property is maintained. If you deducted a contribution of tangible personal property, like a painting, jewelry, antiques, at its full fair market value, which is usually only allowed if its use is related to the charity's purpose.
Right.
And the qualified organization then puts it to an unrelated use, meaning a use that is unrelated to its tax-exempt purpose or function. You may need to recapture part of the tax benefit you previously received.
Can you give an example of related versus unrelated use?
Sure. If you donate a valuable painting to an art museum or an educational institution with an art program, and it's intended for display, study by art students, or preservation in their collection, that's generally considered a related use. The deduction would likely be the FMV.
Makes sense.
But if that same educational institution, whose primary mission is education, not art dealing, instead sells the painting immediately to just fund general operations, that's generally considered an unrelated use because selling art isn't their primary exempt business or mission.
And what happens then if it's determined to be an unrelated use by the charity within that time frame?
You, the donor, would then generally need to include the amount of your original deduction that exceeded your basis in the property as ordinary income on your tax return for the year the organization disposes of it or puts it to that unrelated use. This effectively reverses the tax benefit you received on the appreciated part of the donation, ensuring the full FMV deduction was truly for a charitable purpose, consistent with the organization's mission and the property type. It reinforces the idea that the IRS provides certain deductions for specific types of charitable impact.
We've covered a lot of ground now on qualified organizations, valuation, documentation, potential pitfalls. Now let's talk about the ceiling, the limits on deductions, because even if you follow all the rules meticulously, there are still caps on how much you can actually deduct in a given year, and these are based on your adjusted gross income, or AGI. Can you remind us what AGI is, roughly?
Sure. Think of your AGI, adjusted gross income, as your gross income from all sources minus certain specific above-the-line deductions. It's calculated before you take things like the standard deduction or your itemized deductions, which is where charitable contributions usually go.
Yeah.
It's a key number the IRS uses as a baseline for limiting many deductions and credits, including charitable contributions.
Right, and the IRS limits your total charitable deductions based on this AGI.
That's exactly right. It's a critical point for strategic tax planning, especially if you make large donations. The IRS essentially says you can't just zero out your tax liability by donating everything, no matter how generous you are. They set different slices or percentages of that AGI pie that can be used for deductions from different types of donations to different types of organizations.
So bigger slices for some, smaller for others.
Generally, yes. Bigger slices usually for cash going to mainstream public charities, slightly smaller slices for certain types of property donations, and even smaller slices for contributions to certain types of organizations or contributions made for the use of an organization. Your total charitable contribution deductions for the year are limited by these various percentages of your AGI. This is where understanding the categories of organizations and the types of property you're donating really matters for calculating your actual deduction.
Okay, so what are these main categories and their associated AGI limits? It sounds like a bit of a cascade or waterfall system, maybe.
It is indeed often described as a cascading system, yeah. There are two main categories of organizations for AGI limit purposes. First, you have 50% limit organizations. This is the broadest and most common category. It encompasses most public charities, think churches, synagogues, mosques, temples, schools, hospitals, government entities, and generally organizations that receive substantial support from the public. Contributions to these organizations typically have the highest deduction limits.
Okay, 50% limit orgs are the main ones.
Correct. Then you have 30% limit organizations. This category includes certain other types of qualified organizations that don't meet the public support test for 50% status, like certain private foundations, veterans organizations, fraternal societies. And importantly, this 30% limit also generally applies to contributions that are considered made for the use of any qualified organization. Remember that legal arrangement, like a trust, where the charity doesn't have immediate direct control.
Right, for the use of distinction.
Exactly. Those contributions generally fall under the lower 30% AGI limit, regardless of the type of organization.
And how do these different percentage limits actually apply? Is there a specific order of application? Like, do some deductions get priority over others in using up that AGI capacity?
There is a very specific order of application, yes. And understanding this order is crucial for maximizing your deduction and minimizing your current year tax liability. It's a bit like a waterfall, as you said. Certain types of donations get the first dibs on your AGI deduction capacity each year. One, qualified conservation contributions, QCCs. These are actually considered somewhat separately, but effectively first. They're generally limited to 50% of your AGI, but calculated after considering your deduction for all other charitable contributions. However, there's a big potential bonus here. Qualified farmers and ranchers may be able to deduct QCCs up to 100% of their AGI under specific conditions, which is a very powerful incentive for land preservation in those cases.
Yeah, 100% AGI. Wow.
Yeah, potentially. Then, after considering QCCs, the general flow is an ORAXO. 2. Cash contributions TO 50% limit organizations. These are generally deductible up to 60% of your AGI. This is often the most straightforward and highest limit available for simple cash gifts to public charities.
60% for cash to public charities.
Okay. 3. Non-cash contributions, other than certain capital gain property, TO 50% limit organizations. This covers things like donations of ordinary income property, like inventory or short-term capital gain property, or capital gain property where you elect to reduce its FMV by the appreciation. These donations to 50% limit orgs are limited to 50% of your AGI. This is where your typical donations of clothing, household goods, or business inventory often fall.
Okay, 50% for most non-cash to public charities.
4. Cash and non-cash contributions, not capital gain property, subject to the 30% AGI limit. This primarily covers contributions made for the use of any qualified organization or contributions to non-50% limit organizations, like those private foundations or veterans groups. The deduction here is limited to the smaller of two amounts, either 30% of your AGI or 50% of your AGI minus your contributions to 50% limit organizations, including capital gain property that falls under the 30% limit, which we'll get to next. This is a more restrictive limit.
Right, getting tighter.
5. Capital gain property contributions subject to the 30% AGI limit. This is a really important one. It applies to donations of appreciated capital gain property, property held more than a year that's gone up in value, like stock or real estate, made to 50% limit organizations if you don't make that election to reduce the FMV by the appreciation, which you usually don't want to do, as we'll discuss. This type of donation is limited to the smaller of 30% of your AGI or 50% of your AGI minus your contributions to 50% limit organizations that fall under the higher 60% or 50% limits.
So appreciated property to public charities caps at 30%.
Generally, yes, at 30% of AGI for the FMV deduction. And finally, 6. Capital gain property contributions subject to the 20% AGI limit. This is the most restrictive category. It applies to appreciated capital gain property donated to non-50% limit organizations or contributions made for the use of any qualified organization. It's limited to the smallest of several calculations, often boiling down to 20% of AGI or what's left under the 30% limits.
Wow. Okay, that sounds incredibly complex with all those different percentages, 60, 50, 30, 20, and a very specific order of application. Can you maybe give a quick example to illustrate how these different limits might interact, or maybe how they don't necessarily cannibalize or directly reduce each other? Because that seems to be a common assumption people might make.
Certainly. This is where the strategy really comes into play, understanding the interplay. Let's say your adjusted gross income, AGI, is $50,000. During the year, you did two main things. First, you gave appreciated capital gain property, stock held long-term, with a fair market value of $15,000 to a 50% limit organization, like a university. You didn't choose to reduce the property's FMV by its appreciation. This contribution, as we just said, is subject to the 30% AGI limit. 30% of your $50,000 AGI is $15,000.
Okay, so right at the limit for that one.
Right. Second, you also gave $10,000 in cash to a different organization that is not a 50% limit organization, maybe a private foundation or a veterans group. This cash contribution is therefore subject to that other 30% AGI limit we mentioned, contributions to non-50% limit organizations. Again, 30% of your $50,000 AGI is $15,000.
Okay, so you have a $15,000 donation subject to one 30% limit and a $10,000 donation subject to another 30% limit. How does that play out for the total deduction you can take this year? Does one reduce the other?
This is the interesting part. In this specific scenario, both contributions could actually be fully deductible in the current year. Here's why. The $10,000 cash contribution to the non-50% limit organization is fully deductible because it's not more than the smaller of 30% of your AGI, $15,000. The 50% minus 30% leaves a 20% limit, effectively, or $10,000 in this case, $23K, $15K. So the full $10,000 cash donation fits within that.
Okay, the cash fits. What about the stock?
The $15,000 capital gain property contribution is also fully deductible because it's not more than its own 30% of AGI limit, $15,000. And it doesn't get reduced by the other 30% limit contribution in this specific calculation hierarchy. The key here is that these specific 30% limits, while both calculated based on AGI, are applied somewhat independently within the overall structure. Neither amount directly reduces the other donation's deductibility below his own specific limit in this case.
So the total deduction is
Your total deductible contribution for the year would be $25,000, $15,000 stock plus $10,000 cash, which is also comfortably within the overall maximum limit of 50% of your $50,000 AGI. This example illustrates how the different limits can apply to different types of contributions without necessarily cannibalizing each other directly, allowing for a potentially substantial total deduction that really maximizes your tax benefit if planned correctly.
That really drives home how crucial it is to understand the hierarchy and the specific rules for each type of donation to maximize your tax benefit, rather than just assuming a simple aggregate limit applies to everything. But what happens if your contributions, even after applying these rules, still exceed these AGI limits in a given year? Maybe you made a really large donation. Do you just lose that excess deduction forever?
Thankfully, no. That would be pretty harsh. This is a very beneficial rule, especially for people making large contributions, perhaps of highly appreciated assets. If your total contributions eligible for deduction in a year exceed your AGI limits for that year, you can typically carry over the unused portion of your deduction.
Carried over For how long?
You can usually carry it over for up to 5 subsequent tax years. This carryover ability is vital for large contributions, ensuring that your generosity can continue to provide tax benefits for years to come, potentially reducing your future tax liabilities significantly.
That's great news for major donors.
It is. However, be aware that if you do have a carryover from an earlier year, you generally can't use the simpler Worksheet 2 in Publication 526 to figure your current year deduction. You'll need to consult the specific carryover rules and calculations, which can get complex, and this is another area where professional tax advice might be very helpful.
Okay, we've journeyed through the intricacies of non-cash contributions, from what qualifies to how to value it, how to report it, managing those tricky limits. Now let's try to tie it all together with some strategic planning for tax savings. This is where it gets really interesting for you, the listener, figuring out how to optimize your giving and maybe identify the best property to donate specifically to minimize your current year tax liability. So, expert, based on everything we've discussed, what's generally the optimal property to donate for maximum tax benefit?
Okay, for minimizing an individual's current year tax liability, the absolute standout, the real gold standard in non-cash giving, is often appreciated capital gain property that you've held long-term.
Okay, define that again quickly.
Sure, this is property like stocks, mutual funds, bonds, or even real estate that you've owned for more than 1 year and that has increased significantly in value since you acquired it. Think of that stock you bought years ago that has maybe quadrupled in price, or perhaps a piece of land you inherited that's now worth a fortune compared to its value when you received it.
Why is that specific type of property the optimal choice? What's the financial magic trick here that differentiates it from, say, just donating cash or donating property that hasn't appreciated?
It provides a potential double tax benefit, which is a true aha moment for many taxpayers when they grasp it. First, as we discussed under the AGI limits, you generally get to deduct the property's full fair market value at the time of the donation, subject to that 30% AGI limit for donations to public charities. So if your stock is worth $10,000 when you donate it, you can potentially deduct that full $10,000 against your income.
Okay, deduct the full current value. What's the second benefit?
Second, and this is often the key advantage, by donating the appreciated property directly, you generally avoid paying capital gains tax on the appreciation and the increase in value.
Avoid the capital gains tax.
Yes. Imagine you bought that stock years ago for only $1,000, and it's now worth $10,000. If you were to sell that stock yourself, you'd likely owe capital gains tax on that $9,000 gain, $10,000 sale price, $1,000 basis. But if you donate that stock directly to a qualified public charity,
Instead of selling it first.
exactly, instead of selling it first and donating the cash, if you donate the stock directly, you potentially get a tax deduction for the full $10,000 fair market value, and the government never gets to tax that $9,000 gain. That capital gain just disappears, tax-wise.
Wow.
That's money you're essentially keeping out of the tax system, or rather redirecting entirely to your chosen charity instead of sharing a chunk of it with Uncle Sam in the form of capital gains tax. It's incredibly tax efficient because you get a deduction based on value, the appreciation, that you never actually had to recognize as taxable income yourself.
That's a huge incentive. You're essentially eliminating a potential tax liability while simultaneously getting a deduction based on the full current value. Okay, what about those used household items and clothing we talked about earlier? Are they still worth donating strategically if the tax savings seem minimal compared to appreciated stock?
Well, they are certainly deductible, and they are definitely beneficial to the charities receiving them. However, as we discussed, their fair market value is usually quite low compared to their original cost. So while every little bit helps, and it feels good to declutter and support charities, the direct tax savings from donating a bag of old clothes will likely be minimal compared to donating, say, significantly appreciated stock.
Right.
Unless they happen to be higher value, unique items like antiques or collectibles in excellent condition. The impact on your overall tax liability from typical donations of used goods is generally modest, but they are easy to do, widely accepted, and still support good causes, so they have their place.
And for businesses, that inventory deduction we keep mentioning, is it as strategically impactful for pure tax savings as donating appreciated capital gain property is for individuals?
Inventory donations can certainly provide a valuable deduction for businesses, as we've outlined, but they come with those specific limitations and calculation rules, often tied back to your basis cost in the goods or your business's net income. They're often a very good option for businesses looking to manage surplus goods that might otherwise go to waste, providing essentially a cost recovery benefit or slightly better, especially for food.
But not the capital gains angle.
Right. They are structured differently and don't offer that same powerful capital gains avoidance benefit that donating long-term appreciated capital assets does. Inventory deductions are typically more about managing business operations and providing a deduction related more closely to the cost of the goods being donated.
And qualified conservation contributions. We know they're incredibly complex, but can they be strategically significant for someone with, say, a large landholding or a historic property?
Oh, absolutely. QCCs can be incredibly significant from a tax strategy perspective for individuals or entities holding valuable land or historic structures, especially if the property clearly meets those specific conservation purposes. The resulting deduction can be very substantial, often representing the significant loss in potential development value due to the perpetuity of the easement.
And potentially 100% AGI for farmers.
And potentially that 100% AGI deduction limit for qualified farmers and ranchers, yes. However, given their extreme complexity, especially regarding the valuation, the baseline documentation, the perpetuity requirements, and particularly those strict disallowance rules for partnerships and S corporations we highlighted.
Right, the 2.5x basis rule.
Exactly. They require extremely careful advanced planning and dedicated expert professional guidance, legal and appraisal, to ensure the deduction isn't inadvertently lost and the conservation goals are properly met according to IRS standards. They're absolutely not a DIY tax project.
It also sounds like timing the donation correctly is critical for determining which tax year the deduction applies, which is obviously very important for current year tax liability planning.
It absolutely is. The general rule, as we touched on, is that the donation occurs, and thus the deduction applies, on the date the property is physically delivered to the charity, or the legal title is officially transferred, provided you don't retain any limiting rights that prevent the charity from taking possession and control.
So, gotta get it done by year end.
For tax planning purposes, yes, you need to ensure the transfer happens within the relevant tax year for which you intend to claim the deduction. If you want a deduction on your 2024 tax return, the property generally needs to be in the charity's hands or the title officially transferred by December 31st, 2024. This becomes especially important for planning at year-end. You can't just decide on December 30th and assume it counts if delivery happens in January.
So what does this all really mean for our listener? We've gone through all these intricate rules about qualified organizations, complex valuation methods, strict reporting forms and deadlines, AGI limits, specific property rules. It really does feel like navigating a maze sometimes. What's the biggest, most important takeaway for our listeners who are looking to make strategic non-cash donations specifically to minimize their current year tax liability?
I think the biggest takeaway is that while potentially incredibly rewarding both philanthropically and financially strategic, non-cash giving is not simple. It's far more sophisticated and has far more potential pitfalls than just writing a check or donating cash.
Definitely more complex.
Yes. Given the complexities of valuation, the stringent requirements for qualified appraisals over $5,000, the nuanced AGI limits based on property type and organization type, and the very specific rules for different kinds of property, especially things like real estate, business interests, art, collectibles, and particularly QCCs working with a qualified tax professional or a specialized professional appraiser, is often not just helpful, but absolutely crucial.
Crucial, especially for the big stuff.
Especially when you're dealing with high-value items, unique assets, or particularly that appreciated long-term capital gain property, where the potential strategic tax benefit is so high. Getting the details wrong on those can cost you dearly, either through a disallowed deduction or significant penalties.
So the messages. For complex non-cash donations, it's definitely not a DIY project if you want to ensure compliance and truly maximize your financial benefits alongside your charitable goals.
Exactly. Not if you want to be confident you're maximizing your legitimate deduction and, maybe more importantly, avoiding costly penalties or challenges from the IRS for misstatements, improper valuation, or incorrect reporting. While the IRS does offer resources like VITA and Free File for general tax help, for these kinds of specialized, higher-value non-cash contributions, expert guidance is truly invaluable to ensure full compliance and achieve the best possible outcome. The strategic identification of what property to donate to minimize your current year tax liability is fundamentally tied to understanding these complex rules, especially appreciating the unique power of donating that long-term appreciated capital gain property.
That's a really powerful closing message. Be informed, be strategic, understand the potential benefits, but don't hesitate to seek expert help for these potentially high-value, high-impact decisions.
It really is. It's all about being informed and smart with your generosity, allowing you to turn your existing assets into impactful gifts that also happen to benefit your own tax situation in a significant way.
Well, we set out today to equip you with the knowledge to make smarter, non-cash charitable contributions, not just for the good of the organizations you support, but potentially for your own financial well-being, too. From understanding what makes an organization qualified in the first place, to navigating those complex valuation methods, to deciphering the web of AGI limits, and meticulously documenting absolutely everything, it's certainly a deep pool of information we've waded into.
I think the real aha moment here, hopefully, is recognizing that strategic non-cash giving is so much more sophisticated than just writing a check. It's about truly understanding the specific nuances of what assets you own, how the IRS requires them to be valued, and the precise rules for documenting your generosity correctly. Mastering this allows you to genuinely minimize your tax liability while maximizing the impact of your gift.
So as you look at your own assets, maybe that old painting gathering dust in the attic, a collection of books you've outgrown, perhaps a portfolio of stocks that has soared unexpectedly, or even that unused piece of land you own, consider not just their personal or sentimental value, but their hidden potential, their potential to support causes you truly care about, while also creating potentially surprising and significant benefits for your own tax situation. What overlooked non-cash asset in your possession might just be your next powerful strategic charitable contribution.